Jerome Powell just gave this crypto bull market the green light, the go-ahead to send it all higher. Last Friday, he delivered a series of dovish remarks that indicated to the market that rate cuts are coming. And the response? Markets went crazy. In this video, I'm going to break down what exactly I think is on the horizon for crypto markets and the Fed, what you need to know as an investor to stay on the right side of market risk, and how you can prepare for the final blow off top. If that sounds good to you, hit the like and subscribe, and let's dive into today's video. So as we all know, Jerome Powell was set to give a speech last Friday at the Jackson Hole Symposium, and his remarks were basically going to set the tone for the coming weeks in the crypto market. Leading up to the speech itself, markets were actually a little bit nervous, as Powell has usually been fairly hawkish in his remarks, not typically signaling or preparing the markets for any kind of rate cuts. What we got instead was a very dovish Jerome Powell, who signaled that not only are cuts coming, but they're less concerned about the tariff-driven inflation and more concerned about the weakening labor market, signaling more cuts ahead. Remember that as the labor market weakens, the case for rate cuts becomes higher to help stimulate the economy and help push up the labor market to prevent it from getting too soft. This is what economists and market analysts were looking for in Jay Powell's speech to ensure that he would be cutting rates. If Powell went out there and said that the labor market was looking solid and that the labor market was not showing any signs of weakness, that would be an indicator to investors that he was probably not planning on cutting rates, or at least not planning so yet. The fact that Jay Powell went out and actually talked about the weakening labor market gave investors a tip that rate cuts were probably a higher probability than not. Now, I got a quick 10-second video here from the man himself, Jay Powell. Listen to what he has to say about the weakening labor market.
This unusual situation suggests that downside risks to employment are rising. And if those risks materialize, they can do so quickly in the form of sharply higher layoffs and rising unemployment.
And so in order to stop those risks from materializing, the Fed is going to cut rates and help support the labor market by stimulating economic growth. On the other hand of the dual mandate, aside from the labor market, is inflation. The big concern was that we were going to see tariffs driving up inflation, essentially making goods and services more expensive for the average retail investor. This again turned out not to be the case. And Jay Powell again addressed this in his speech. He mentioned that tariffs were only a one-time price increase and that the effects from the tariffs were largely muted. Got about 15 seconds again from Jay Powell himself. Have a look.
A reasonable base case is that the effects will be relatively short-lived, a one-time shift in the price level.
A one-time shift in the price level. And this is what experts have been saying all along, that tariffs are going to create some inflation, but they're unlikely to create durable, lasting inflation. And so after several months of looking at the data, the Fed has decided that the tariffs and the labor market both warrant cutting rates. And so to break this all down for you, I've got former Fed Governor Randy Kroszner. He's going to mention both sides of the mandate and what he thinks the Fed are going to do as a result. 30 seconds, have a look.
And he basically said, we've waited and we've now seen relatively muted impact of the tariff, so we don't really have to wait much longer to potentially start cutting rates, because the labor market clearly has been weakening. That data that came out, those revised data came out recently, suggests that's the labor market's weakening. And he said there's really no sign of the tariffs causing inflation expectations to become unanchored. So it's really more of a one-off rather than an ongoing inflationary cycle. And so I think he's made it pretty clear he's ready to start moving in September.
And this is exactly what markets started pricing in shortly after Powell started giving his speech. Once he mentioned weakness in the labor market, once he mentioned that tariffs were only a one-time price increase, we saw crypto and stocks start to rally to the upside, and we saw Ethereum surge up to near all-time highs as markets anticipated more liquidity and more economic stimulus as a result of a rate cut. What I believe is going to happen as more economic data releases, as we see continued weakening in the labor market, and as we see further evidence that tariffs are not contributing durably to inflation, I think the markets are going to begin to price in more cuts. Where there's smoke, there's fire. And when the Fed cuts once after a period of not cutting, what that usually signals to the market is that they're ready to begin a sequence of rate cuts. I've got David Rosenberg from Rosenberg Research. He's going to break down why he thinks that a sequence of rate cuts are coming. About 30 seconds. Have a listen.
Well, I think this was more than just mildly dovish. I wouldn't say it was super dovish. There were enough caveats, but when you read between the lines and you assess the tone, this was not just tipping his hat for a September 17th rate cut. I think this was actually a move towards suggesting that we're going to be in for a sequence.
They tend to cut several times as opposed to just once, because when they decide to cut, it means that they're moving monetary policy to an easier position to help stimulate growth in the economy because of what they're seeing. The weakening in the labor market is of concern to the Fed because it can get away from them quickly. And this is what Powell said in the clip that I showed earlier, that the risks can quickly materialize into something much bigger, a much bigger problem. And in order to get out in front of that, the Fed tends to make a series of policy adjustments lower to help prepare the economy for any weakness that might be coming in the months ahead. And this is exactly what the Fed did last year. They cut in September, November, and December a series of rate cuts for a total of 100 basis points. What the Fed actually did in September was they cut by 50 basis points. I believe that this scenario is now on the table. The reason the Fed cut by 50 points in September last year was essentially as an insurance policy to get ahead of a weakening labor market. Jay Powell and the Fed saw some concerning labor market statistics, and cutting by 50 basis points was a way for them to get out in front of the issue, to preemptively get in front of additional cooling data by giving more stimulus to the economy before it got to that point. And Powell even said himself that the time to support the labor market is when it's strong, not when you start to see layoffs. Once you start to see layoffs occurring, it can create a chain of layoffs. It can create a layoff cycle. And that's a vicious cycle that can have a serious impact for an economy. Rather than sit around and wait for the cycle to begin, the Fed, I think, is likely to cut by 50 if we continue to see weakening in the labor market. This is not my base case. Let me be clear. But if we see continuing weakness in the labor market in the data that we're going to see between now and the next FOMC halfway through September, and if we see inflation continuing to come at or slightly above, slightly below expectations, basically showing us that tariffs are not driving up inflation too significantly, I think a 50 basis point cut is on the table. And I'm not the only one. Jeremy Siegel from the Wharton School of Business also believes that a 50 basis point cut could be on the table if the right conditions are met. Let's hear what he has to say about it. 30 seconds. Have a look.
We saw a rate. Now, I don't know if it's going to be 50. I think 50 depends pretty much on what the August payrolls are going to be. If we got a negative print, it might be 50. But I think 25 is certainly in the bag, barring some sort of crisis we don't foresee at the present time.
And so history doesn't often repeat, but it usually rhymes. And whether or not we see 50 basis points now and then 25 in October or December, or whether or not we see 25 in each of the following 3 FOMC meetings for a total of 75 basis points, one thing I think is for sure, and that's rate cuts are coming. And this is bullish for risk assets in general. As investors, it's important for us to keep a reasonable expectation for what the Fed could be doing. Whether or not they're going to raise rates, whether or not they're going to lower rates or keep rates steady, this gives us the clarity and the conviction that we need to either position accordingly to take profits or to just sit still and weather volatility to come out clean on the other side. Personally, I think that's the key to succeeding in crypto. I've been sitting on my bags for months, close to a year, really without even checking them. I've been sitting comfortably through the volatility. Why? Because I'm tuned into the macro. I understand the forces that move markets and why we should be bullish in the long term. I understand that the Fed is likely to cut rates over the coming months, giving the economy a boost and sending risk assets higher like we saw on Friday. When the Fed cuts rates, what this essentially does is makes the cost of new capital cheaper, allowing businesses and individuals to borrow money for less interest. This liquidity eventually finds its way into markets, finds its way into the economy. It drives up the prices of assets and really drives up the economy just in general. This is bullish for us as investors, and knowing that this is ahead gives me conviction to weather any storms that might come between now and then. And this is exactly what this channel is designed to do, to keep you up to date with the macro developments, help give you the conviction that you need to sit through the volatility and come out the other side with your gains intact. One of the biggest mistakes that crypto investors make today is over trading, over leveraging, over positioning, when you should probably just be sitting in your bags and waiting for market conditions to send it all higher. That's how bull markets work. And if you stay tuned to this channel, I'm going to break down how bull markets evolve and what signals you can be looking for to let you know when to sell or when to go back in. So if that sounds good to you, hit the like and subscribe button down below, comment if you've learned anything, and be sure to tune into more videos in the future so we can keep you up to date with markets and help you retire on time and comfortably. Thanks for listening. We'll see you in the next one.